I'm Richard Dale, representing Sydney Angels. We're an angel investment group with about 85 members who invest in startups together in a team-based investing model. Angel investors invest their own money in startups, and to date, Sydney Angels has invested in about 73 startups since its establishment in 2008. Today, I'm going to explain term sheets. These are an important step in our investment process, and it's also an important step for most professional investors, and it's something that founders will encounter. We've run this session in Spark for several years now, previously in an interactive workshop format. This year, because of circumstances, it's going to be online like this. And so rather than me interacting a lot with the audience, I'm kind of going to be asking rhetorical questions and then answering them. But we do have Q&A set up on as well as chat. So please pop your questions in the Q&A and chat, and we'll try to answer them at various points during the presentation. I'll also monitor them as a way of directing where I spend my time. We're also going to run a poll to see how much knowledge you already have about term sheets. We don't know who you are, so it's a little bit strange. So if you could answer that poll, please, so we get a sense of where you're at in your knowledge of term sheets, that would be very, very helpful to me so I can pitch at the right level. I apologise in advance if the slides that you see as I go through this presentation are a bit wordy and hard to read on your device. That's because these slides were not designed for this kind of format. But I will do my best to talk you through the key points, and the slides will be available for you to download pretty much immediately off the Sydney Angels company page on LinkedIn. So if you can't read the slides, download them, and that way you can read them. Okay, let's start. So what is a term sheet? It's just a few pages in plain English describing the key points of a deal. It's what investors use to document a negotiation with founders of a startup. It's usually non-binding, except for keeping it confidential. It's usually drafted without lawyers being involved, although lawyers are perhaps being consulted in the background for advice. It saves on time and expense, and it's the brief that you give the lawyers later on when you've agreed the terms of a deal and you want to get the transaction documents drawn up. You may not be able to read this very well, but what I'm displaying at the moment is the first 2 pages of a typical term sheet, in this case the Sydney Angels template term sheet for ordinary shares. In the session that we have today, I'm going to explain what some of the terms are that you might be able to see on this term sheet and what they mean and why they're there. So, who needs to know about term sheets? Well, all the different types of people that might be involved in capital raising at some point. It's important that everyone understands the language, the terms, and so that people are not confused and everyone knows what everyone's talking about. Term sheets for startups have some special features and characteristics which you wouldn't find in term sheets for an established company or for a private equity type deal. Startup term sheets are different, and that's because startups are at a different stage in their development as a business and represent a different set of risks for investors. I've been involved with startups and VC investing for a long time, and I've seen many term sheets. This gives me a sense of what's normal, what's fair, and what's reasonable in a given circumstance. But when you create and encounter a term sheet for the first time, as many founders do, how do you know what's fair and reasonable and what's normal? Investors normally have more experience with term sheets and terms and deals, and so they have a knowledge advantage relative to founders. In this session today, I want to do two things really. One is to try to level the playing field a bit in terms of knowledge, and if possible, try to get everyone speaking the same language so that words and terminology don't get in the way of good communication and talking about the key points of a deal. So, a couple of controversial rhetorical questions for you. Why bother with term sheets? It's a non-binding document that doesn't commit anyone to do anything, so why bother? Why not just go straight to binding subscription agreements and shareholder agreements? And aren't safe notes easier and more modern? Why not use those? So I'll try to answer some of these questions as we go through the presentation today. How should term sheets be used? Some more rhetorical questions for you. Should you offer investors your term sheet or ask them for theirs? At what stage in discussion should you expect to get a term sheet, or should you ask for one, or should you present one? What is fair to ask? Which terms should you resist, and which terms should you insist on? How can the process be made a more positive, constructive experience for everyone? Because at the end of the day, a term sheet is a way of documenting a negotiation, and negotiations can be hard work. Avoidable problems do arise, which is the reason for this session. We want to demystify and try to reduce the types of problems that are listed on this slide that you might be able to read. First thing is that the terms and terminology involved in term sheets and investing are often not properly understood, which can lead to surprises and suspicion and arguments later on. As I already mentioned, there can be uncertainty about which terms to include or exclude and whether to make concessions now or later. The terms may appear to be tough, but not unnecessarily unreasonable, which can lead to the other side feeling as if they're being treated unfairly. They may be right, or maybe they just don't understand the terms, and the terms are in fact perfectly reasonable. One or both sides may not be across all of the details, and they get surprised later on when they see the details drawn up in black letter law by the lawyers, and they go, wow, I never knew I was agreeing to that. So it's better to have these things understood at the beginning rather than at the end of the process. And in general, in general, communication can be improved, and we think the onus is on the investors in this regard, because the investors generally know more about deals and term sheets than the founders do, because they've just been involved in more of them. So we would like to see investors coaching founders on terms and term sheets and explaining things, rather than presenting things and expecting the founders to figure everything out. So at this point in this session, when I've done it with a live audience, I turn this into a bit of a quiz, and I'd go through a number of questions with the audience to see how much you already know about term sheets. Now, if you've been doing the poll, I might be able to get an idea already of your level of knowledge. I can't see anything coming up yet, so I'll just have to go blind. Oh, hang on, I have some information here coming up. Wow, okay. So according to this poll, I don't know how many responses it is, but 61% have never seen a term sheet before. Okay, all right. So it's a good thing I'm not asking you these questions in real life, because you might not be able to answer them. Okay, let's go. So these are going to be rhetorical questions. I'll read the question and then I'll answer it for you. Which of these is a pre-money valuation? Now, before I get into which of the answers are correct, I'll just mention right now that valuation is a big topic all on its own. I'm not going to be getting into valuation and how to value a startup in this session, but if you tune in later in the week, my colleague Adrian Bunt will be running a session called How to Value a Startup, which goes into that in some detail, and that would be well worth tuning into. But back to the question, which of these four choices is pre-money valuation? Well, it's a trick question, really, because arguably they're all correct answers. But the first one, A, is the most simple and most accurate answer to give. It's the pre-money valuation is simply the number of shares outstanding before investment multiplied by the share price that's been agreed or is being offered for investment. Okay, next question. What is fully diluted pre-money valuation? Why is it? How is it different, and why use it? Well, it's the pre-money valuation that the investor is effectively paying when you take account of any options or preference shares or convertible notes, which might turn into ordinary shares in the future. What they do is they reduce the percent of equity that the investor will be getting for their investment. So, for example, if an investor was investing $500,000 on a $2 million pre-money valuation, that would give the investor 20% equity. But if there are 20% options or preference shares or C notes to convert at some point in the future, the investor would only end up with 16% equity. So although the headline pre-money valuation was $2 million, the pre-money valuation on a fully diluted basis that the investor is paying is actually $2.6 million, or 31% more expensive. So that's why focusing on fully diluted pre-money valuation is a really important thing for investors, and something that founders also need to understand. What does on an as converted basis mean? This is a term you'll often see in legal documents, shareholders agreements, term sheets. And what it means is that you take all the securities issued by a company, which may include preference shares and convertible notes, and as well as options that are vested, and you convert them to ordinary shares to see what the resulting equity percentages would be. And so when you see on an as converted basis, it means this is the equity that everyone would hold if all those other things were converted to ordinary shares. And this is important for things like voting rights and obviously valuation. What is conversion price and where is it used? Well, conversion price is the price per ordinary share that a preference share or a convertible note converts into. For example, an investor might invest in preference shares, which they pay $1 each for. In a future down round, those preference shares might convert into 2 ordinary shares, which means that the conversion price was 50 cents. How does that concept of conversion price relate to anti-dilution protection? Well, anti-dilution protection is something that's included in term sheets where you have preference shares or convertible notes, and what they're designed to do is to protect investors if the company goes on to raise money at a lower valuation than what the investor paid. And the conversion price is the mechanism by which those preference shares and convertible notes adjust the number of ordinary shares they convert into to protect the investor, so that if the valuation in the future goes down, the investor gets a greater number of ordinary shares, which to some extent compensates for the fact that they paid a high valuation at the time that they invested. What are two types of preemptive rights that investors would want to have? Well, the first one is the right to subscribe for any new shares the company or new securities the company might issue in the future. and the other is the first right to buy any shares an existing shareholder is selling. These preemptive rights are really important. That's because when investing in startups, investors know that most startups will in fact fail. But for the ones that actually go well, investors would like to invest more money. This is the option value of investing in startups. So the preemptive rights are the thing that guarantees that the investor can do that. Preemptive rights are also useful for kind of keeping it in the family. When someone's wanting to sell their shares, it gives the existing shareholders, the existing investors, the opportunity to buy those shares before they're offered to an outsider on the same terms. Now I'm going to go through three sets of terms now: tag-along rights, drag-along rights, and information rights. These are all very important terms for investors, and I'm going to explain each one of them. So tag-along rights, these are the rights that if a founder wants to sell their shares to an outsider, then the outsider also has to buy a proportionate number of the other investors' shares, if the investor wants to sell, of course. This is there to protect an investor from being stranded in a startup in a situation where the founder is selling down or leaving. The next one is drag-along rights. This is similar but different. This is where if an offer is received to buy the company, to buy 100% of the shares in the company, and the offer is a good offer, that is, it's offering a fair price to everyone, drag-along rights allow the majority who want to sell to force a minority who's opposed to selling to also sell their shares, so that the acquirer can get 100% of the shares, which is what the acquirer usually wants. And the third of these very important rights is information rights. These are regular, usually monthly reports on business KPIs, finances and runway. In other words, how much cash has the business got left to run. Information rights will also include the rights having an observer on the board. Having this information is important because it allows an investor to do two things. The first one is it allows them to know what's going on and to help where they can, because startups always need help. And the other thing it does, of course, is it allows investors to take action if things are not going well. It allows them to take appropriate actions to either to protect their interest or to help the company. So information rights are very important. What are critical business matters or reserve matters, which is a term you'll find in term sheets and shareholders' agreements, and why do investors want them? Well, critical business matters are typically things that are fundamental to the nature of the business. It's things like the strategy, the business plan, the core assets of the business, the hiring or firing of a CEO. These are very important issues. And it's quite common for investors to say, if those things are going to be changed, you have to have our approval. So this is not a situation where the investor can make these things change. It's a situation where the investors want the right to approve a change because they invested based on those things. If those things change, it's a big deal. It's a big change. So usually there is at some level of investor veto rights attached to certain critical business decisions. And this is a way for the minority, because investors are always in the minority in startups, it's a way for the minority to protect themselves. Question 9, last question. What is founder vesting and why is it a good idea? Well, founder vesting means that founders have to earn back their shares, effectively have to earn back their shares, typically over, say, a 3-year period. The purpose of this is to align the founders with the long-term nature of startup investing so that there is no incentive for founders to walk away, because if they walk away, they won't have any shares. It also is valuable for co-founders to have founder vesting because it means that their other founder can't free ride. If they free ride, they'll also lose their shares. So it's a way of keeping everyone honest and aligned and committed for a reasonable length of time, because startups take several years to actually come good. So you want people to be committed for the long term. I'm just checking the question list here. Okay. Please do fire up any questions or chat so that it helps me if I know what you're thinking, because I can direct some of what I say towards those points of interest. So what I've just given you is a brief intro to term sheets and some of the concepts and terms. Term sheets are an important step in our investment process at Sydney Angels. And as I mentioned at the beginning, Sydney Angels is an angel investment membership organisation that was established in 2008. We currently have about 85 angel investor members, and they invest their own money in startups in a wide variety, and the members themselves come from a wide variety of business and professional and technical backgrounds. We operate a team-based investment model, which means the members form teams around startups that they like, and they do due diligence together and invest together in those startups. We also have what we call a sidecar fund, the Sydney Angel Sidecar Fund, that matches our members' investments in every startup that they invest in. And obviously, I've got to say this, if you are a startup or a founder and you would like to apply for investment, please just go to Sydney Angel's website and apply online. We have a simple online application process and it costs you nothing. Sydney Angels has been going for quite a few years now, 12 years. We keep on growing every year. And on this slide in front of you, you can see a couple of charts. The chart on the left shows in the green our membership base. We have an active membership base. We have also a reasonable level of turnover in our membership base. And the blue line is the total number of startups invested to date. Currently 73, with 3 more probably going to be invested in the next few weeks. The right-hand chart shows the total money that's been invested in startups that Sydney Angels members have invested in. The numbers are millions of dollars. So Sydney Angels and Sydney Angels members and the Sidecar Fund are typically investing around $2.5 million a year in startups between them. But what's happening with the startups is the ones that go well attract lots more investment in later rounds. And so we're looking at figures of something like $40 to $50 million a year being invested in companies that Sydney Angels members have invested in. And that's what powers startups on to bigger and better things. And hopefully one day an exit for those very early Sydney Angels member investors. We've invested in a diverse range of companies. I won't talk through all the logos on the logo board there, but it's everything from software as a service and marketplace businesses through to medical devices and radiopharmaceuticals. So a very wide, diverse range of startups. We look at every deal on its merits. We don't have sector or sector filters. We are investing more by stage of business. That is, typically it's in the first round after friends and family investors. But in terms of sector, we look at every deal on its merits. Our investment process cycles 6 times per year, starting off with the batch of new applications we've received online through our website. Typically, we'll get about 40 to 50 of those over each period. And we progressively review those and select the ones that look interesting. And we invite the 6 most interesting ones to come and pitch at what we call a deal screening meeting, where they each have 10 minutes to pitch and 10 minutes Q&A with a panel of our members. Coming out of the deal screening meeting, we pick the best 3, which then go to what we call our members meeting, which is the same as the deal screening meeting, except that it's a larger audience. It's typically 50 to 60 of our members, and only 3 companies, same format, 10 minutes pitch, 10 minutes Q&A. And what happens at the members meeting is that syndicates or groups of our members form syndicates around those of the startups they found interesting, and that's where they commence their due diligence process, getting to know the founders better and spending time looking at the business. And the result of that is we're making each cycle, typically 1 or 2 companies will get invested for about 6 to 8 new investments per year. And we've been doing that consistently now for a long time. Also, during the course of the year, Sydney Angels members are investing follow-on amounts in the companies they've previously invested in. So we're a very active group. Now, term sheets are an important stage in our investment process. On the slide in front of you, you can see 5 stages, and term sheets for us are in the middle of our process. So at the left-hand end is where the members who saw a startup present at our members meeting formed a syndicate around that company, had a first follow-up meeting with the company to start the due diligence process. After several weeks of due diligence, the members will form a view as to whether they like the company as much as they thought they did, and if they did, they'll want to start talking about terms of investment, which is the term sheet stage. And the idea there is that you don't want to start having the negotiation about terms until you know that you want to invest because you like the company, but also you don't want to leave it to the end because you don't want to go through the full process without knowing that you and the founders, or the founders and the investors, depending on who you are agreed on terms. So for us, the term sheet stage or the negotiation stage in the middle is the right place. Now, in that term sheet stage, investors don't normally have lawyers involved. Founders might. Founders might also have their mentors or their advisors involved, because you are talking about the terms of the investment, but it's not meant to be a legal discussion. It's meant to be a commercial discussion, but you do need to understand what the terms mean. So, if you don't know, if you're in a negotiation and you don't know what the implications of the terms are, it would be a very good idea to take some advice. Investors, particularly angel investors, will try to help you, but remember you're negotiating with them, so they can't be your advisor. So the purpose of the term sheet for us, for Sydney Angels, is that it's a way of recording what we've agreed on. So remember I said at the beginning, term sheet is a non-binding document, but it does record what you've agreed on, key terms, things like how much money, at what valuation, for what rights. And so in our investment process, which you can see again on the slide in front of you, there's a negotiation process that goes on. The investors will identify the key terms that they want. They will put those into a term sheet. They will discuss the term sheet with the founders. The founders will then, think about it and may or may not agree. They might suggest some alternatives. And you might go around that cycle a few times. But at the end of it, you'll end up with an agreed term sheet. Sometimes there is already an existing term sheet, either from the company, from the founders themselves, or from another co-investment group. That's okay too, but it doesn't change the fact that there will be key terms that, for example, the Sydney Angel Syndicate would want to see in the deal, and maybe the existing term sheet or the co-investors term sheet is going to need to change as well if you want to bring all the investors together and have them all invest. So what I'm now going to do is I'm going to talk about the kinds of term sheets that exist and why they're used, and the kinds of terms that they include. At Sydney Angels, we use 3 types of term sheet for different situations. So you may be able to read this slide on your device, but basically it has 3 columns on the right: ordinary shares, preference shares, and convertible notes. The colour coding is traffic light style, so green means good, red means don't, orange means maybe. And the first column is a range of situations which may or may not apply to a particular deal. For example, this first situation listed there is it's the first professional round in a startup. That is, the previous investors, if there were any, were friends and family. And there are other situations down there, for example, like can't agree on valuation, for example, or the company's been around for a while and there's some legacy issues or some baggage in the company. All of these different situations mean that sometimes you need to use a different type of term sheet. For most of the deals that Sydney Angels does, which are typically startups where if there has been any prior investment, it's typically from friends and family. Usually ordinary share term sheet is perfectly fine. But as you can see from the color coding here, there are situations where you would not use ordinary shares. And typically that's where there are existing preference shares or convertible notes or loans in the company, in which case investing on ordinary shares would be foolish for an investor to do, and they'd want to use something else. So we have those 3 different types of term sheets at Sydney Angels. The vast majority of deals that are done using ordinary shares, but we also sometimes do preference share deals or C-note deals, depending on the circumstances. You might remember earlier I talked about preemptive rights. Well, one of the reasons why preemptive rights are important, if you're investing using ordinary shares, as many Sydney Angels deals are, is because later on there might be a VC round or a down round with a convertible note. And if those things happen, because you have preemptive rights, you have the ability to buy some of those advantaged securities at that point in time. And this is one of the reasons why, if you are investing in startups, it's very important to keep some dry powder available to invest in either a follow-on round or one of these situations where you really want to invest to protect yourself, to get some of those extra rights that come with those other securities that are being offered in some future round. You may have heard about something called safe notes or simple agreement for equity. These definitely have their uses, and they're a founder-friendly way of raising capital. What they are is unlike a share or a preference share or an ordinary share or a convertible note, they're simply a promise where the company says, I promise to issue shares at some point in the future at a discount to a price that will be determined by someone else in the future, capped at a certain level so you don't pay too much. So it really is, it's just a promise. It's very useful for raising money from a whole series of individuals over a period of time where the individuals don't necessarily know each other and aren't working together on the investment. It doesn't really suit professional investor groups like Sydney Angels or most VCs, because they would prefer to, first of all, price the investment for the risk they're taking at the time that they invest, and secondly, they would really like to know that they have a firm right to equity in the company, and they get that by investing in an ordinary share, preference share, or a convertible note. And where where you have an organised investment process, the need for something like a safe note is much less because the investors they know each other and they're working together. So safe notes are suitable for some situations, but not for others. All term sheets contain a core investment proposal and a whole bunch of other terms. So the first page or two of a term sheet will focus on the core investment proposal. This will be, who the company is, who the founders are, who the investors are. It'll be how much money is being proposed to be invested, the valuation, which should be stated as a fully diluted pre-money valuation, as I mentioned earlier, which will determine, therefore, how much equity those investors are entitled to. It should describe what they get, whether it's ordinary shares, preference shares, or convertible notes. It may list some approved uses for the funds. So, for example, the funds have to be spent as per the business plan, which the founders and investors have agreed on. And there may be some timing or conditions for investment. For example, there might be some preconditions, certain things need to happen before the money will actually be invested. Or the investment might be tranched into a first tranche and then a second tranche, which is invested if certain milestones are achieved or if certain things happen or a certain amount of time has passed. Then there'll be other rights that the term sheet will describe or allude to, depending on how summary the term sheet is. So there'll be rights relating to chances of getting a return for the investor. And this will pick up the things I've already mentioned earlier in this session. Things like preemptive rights to new issues and the buying of existing shares, tag-along rights, drag-along rights, and dividends. There'll be other rights specified in the term sheet somewhere or alluded to if preference shares or C notes are being issued. That's because preference shares and C notes are more complex than ordinary shares and they have other features. And so there'll be what happens to voting rights in relation to the conversion rate of the preference share or the C note. There'll be anti-dilution protection, preferred dividends, liquidation preferences, and possibly rights to redemption. A third category of terms in the term sheet, which may be spelled out or not, but alluded to, would be rights to board and information. So this could include the rights of a board director, a board observer, and some level of reporting and what those reports or information flows back to investors would be. A fourth category in the term sheet will be rights to approve critical business matters, which we spoke about earlier. Things like, okay, a majority of the investors will need to approve a change to the business plan or a change to the strategy or a sale of core assets. These are those really important big decisions that may not ever happen, but if they do happen, investors want to have the right to say no if they happen. A fifth category of rights will be around alignment of the founders and the staff with the investors. This will pick up things like founder vesting, which I mentioned earlier, good leaver and bad leaver provisions, employment agreements, assigning the IP to the company, non-compete agreements, and so forth. And then in any agreement, there's also going to be a bunch of legal boilerplate. You may not see that in a term sheet. You'll definitely see lots of legal boilerplate in shareholder and subscription agreements. Usually in a term sheet, the only bit of legalese in there is something about confidentiality, but there may be other things in there too. So that's a lot to think about, and given the fact that over 60% of you said you had never seen a term sheet before, I imagine a lot of this has gone way over your heads. Please do grab those slides and read them at your leisure afterwards, and maybe some of it will start to make more sense when you've read the fine print. But can I just say that some of those rights are always important, and others are optional or can be traded off against other things. So in the slide that you're now looking at, I put on a chart some different types of rights or terms, and the x-axis, the horizontal axis, is increasing from left to right how acceptable they usually are to founders, and the vertical axis is how important they are to angel investors. The green ones are usually not controversial. They're usually things that we can all agree on. Things like investing, having sufficient funds in the business so it can do what it says it's going to do. Usually preemptive rights aren't controversial. Information rights, share option plans for staff, conditional tranches, assigning the IP to the company. Usually these things are not controversial. But there's a bunch of others which are important, but sometimes can lead to some level of negotiation and discussion, and may become quite controversial in certain cases. Valuation is an obvious one. That is the core thing that's negotiated in a deal. It determines how much equity investors will get. Other things like drag along and tag along and founder vesting, which I mentioned before, they are important to investors, and clearly they are something that for founders represent a sacrifice. Although, as I mentioned earlier, founder vesting also protects co-founders. The vetoes over critical business matters, those are important to investors, but founders may fear as if that's too much interference. So usually there's some haggling over what those vetoes will apply to and what kind of majority is required to exercise a veto. And in the bottom left-hand box, you'll see something called force and exit. This is a very controversial term. It's not something that's usually practical for angel investors to bother with, because they're investing so early, and it's going to be so long before a deal ever reaches a point where a good exit is possible. Having the right to force an exit is of very practical little value. It is something that you may see in later stage term sheets from late stage VCs, and it's certainly a feature of private equity deals. I'm coming towards the end now. I've got about 7.5 minutes left on the clock. And the way I would normally end this session is, with a bit more time, is I'd do a scenario, a bit of a role play with people, like a workshop style. But what I'd like to do now is just talk you through a typical scenario where Sydney Angels has looked at a startup. We like it. We've proposed some terms to the founders, and there's a bit of a gap between what we're proposing and what the founders expect. So let me set the scene. So yeah, we've done enough due diligence to know that we want to invest. The founders have also been speaking to another investor, another investment group, or another individual, or family office, whatever they are, and they're offering to provide 40% of the money, right? So, there's a significant external co-investor that's in discussions. They're not going to provide all the money, but a significant chunk of the money. And from Sydney Angels' point of view, we like having co-investors. That's good. That's sharing the risk. The issue is, though, that particular co-investor has been more generous in their terms than the syndicate of Sydney Angels members feel is appropriate. And so there's a difference now between what the founders are hearing from one investor and what the Sydney Angels member syndicate is going to propose to them. And this is where negotiation comes in. On this table here, I'm summarising the key terms of the deal. You may not be able to read the fine print. I'm sorry about that, but if I'll just spell it out. We're not that far apart on terms, but there are some gaps. We have the right amount of money, $500,000 in this case, which is a pretty typical Sydney Angels deal. But the Sydney Angels members are proposing to invest in two tranches, 250 and 250. That's a way of reducing their risk if things don't work out as we thought they would. There's also a difference in valuation. The founders were asking 2.5 pre-money, and the Sydney Angels members were proposing $2 million on a fully diluted basis. So as I mentioned earlier, that's that's quite a difference in valuation. But what they've also done is they've said, look, refer to the cap table, and I'll show you the cap table in a moment. There are some other differences too around the board, and there's also, through their due diligence, the Sydney Islands members found that there was a convertible note hanging around inside the company, and that's a loan. And so what they've proposed is that, look, for us to invest, we'd like that senior note to be converted into equity on the same terms as what we're investing. So there's a few differences, and these gaps would have to be closed through negotiation. I mentioned the cap table. So even if the terms in a term sheet seems like an alien language, usually people understand cap tables and numbers. And so it's very important in a term sheet that you have a cap table which lays out the pre-money equity position on both a raw and as converted basis, and then what the equity position would be post-investment. And in this case, there's two post-investment versions because you've got a tranche 1 and a tranche 2. And a good cap table will pull everything together, pull together the number of shares, the types of shares, the percent of equity, the valuation, and the share price. It's all there on one piece of paper. And whether people understand terms or English, everyone understands numbers. And cap tables are a very powerful communication tool. I'm just about coming up to the last few minutes now. So I'm just going to briefly mention that when people talk about term sheets, when you read a term sheet, you'll often hear reference to things like customary terms. Yes, there are customary terms, but the devil is in the detail. So you do need to know what customary terms for a startup investment actually means, because term sheets are summary documents, but when you actually get to the end of the process and you have your shareholders agreement and your subscription agreement and you're signing those binding documents, these customary terms will be spelled out in black letter law, and you don't want to be surprised by them. So it is important to know what these customary terms involve. On this slide, I've listed what those customary terms typically are, and these are things that are part of the deal. They're not the main focus of the negotiation, but they're part of the deal. And it's important to know what they are and what's normal. So things like any preconditions, the information rights, approval of critical business matters, which we spoke about before, preemptive rights, which we spoke about, tag-along rights, drag-along rights, stuff to do with employment agreements, IP assignments, etc., and usually there's a requirement to have directors and officers insurance in place, because usually investors would like to have a non-executive director on the board, therefore they'd like to have some D&O insurance in place to protect them. Term sheets keep getting easier all the time. In my time, they've gone from being very, very sometimes complex and unfriendly documents to being much more founder-friendly these days than what they used to be. But there's still more that could be done to make it easier. We will eventually get around to publishing our term sheets so that you can just read them at your leisure. We'd love to have a set of standardized transaction documents as well, which implement our term sheets to make the process flow more easily. And we'd also love to have a specified set of reporting requirements, once again, to make it easier to get things up and running quickly with a startup post-investment. On the clock, I've got 1.5 minutes left to go. So in that time, I would normally throw to questions, but what I will do is I'll go and look at the questions that have been posted and see if any ones I can answer right now. Okay, there's quite a few questions there. I'll just reel off a couple of quick answers. Someone asked about redeemable versus non-redeemable C notes. Generally speaking, Sydney Angels doesn't else redeemable securities at all. There's a reason for that, because our sidecar fund cannot invest in redeemable securities. Someone else asked a question about safe notes. As I mentioned on the slide where I talked about safe notes, the safe notes suit a particular investment situation where you're dealing with a string of disconnected individuals, it doesn't work. They don't suit a situation where you're dealing with an organised investment group which has their own investment process. Yeah, someone asked a question about how do startups protect their IP while seeking funding, confidentiality, and patents.